Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Edward Yardeni needs no introduction. He is clearly one of the most philosophical and acute bulls out there. He speaks of the Roaring '20s and has been dead on. We're thrilled that Dr. Yardeni could join us for an extended conversation this morning. John Murphy, the giant of technical analysis, and a guy named Ed Hyman all agree, like you, that you have to meld things together. Talk to our audience that has missed the Yardeni bull market of how you use economics to have the confidence to invest.
Well, I think first and foremost, you have to start with the data. I think a lot of economists and strategists sometimes start out with the conclusion of how they think things would unfold and then look for the data that'll support it, especially the economists who tend to be on the pessimistic side about the U.S. economy. I think the important thing is to be observant. And I've observed over the past 3 years that we've had the most widely anticipated recession of all times that never happened. It was a no-show. And I think even now people aren't, it's kind of like Rodney Dangerfield. They're not giving the economy enough respect. It's amazingly resilient.
And that's percentage of the audience doesn't know who Rodney Dangerfield is? Exactly. You're dating himself. He was in Caddyshack. We'll leave it at that. Ed Yardeni, the economist Jimmy Kimmel, was going after Lawrence Kudlow over at Fox Biz last night. You and I remember Larry Kudlow at Bear Stearns years ago emphasizing the nominal statistic. Tell us what you glean right now from nominal GDP, the idea of our real growth plus a very volatile inflation overlay.
Well, I think right now, it's like when you go over to grandma's house and it's a long drive and the kids are in the back asking, are we there yet? I think we're there in terms of the so-called nirvana norm for the economy. The dual mandate has been accomplished. We've got the unemployment rate at 4%. We've got real GDP rising at around 3%. And we got the inflation rate not quite at 2%, but somewhere around 2.5% to 3%. And so the Fed has accomplished what it wants to do, which leads me to conclude that there's really no reason for the Fed to lower interest rates anymore. And indeed, I don't really think that there was much reason for them to lower it by 100 basis points. And my friends of the bond vigilantes seem to agree with me because the bond yields rose 100 basis points as the Fed lowered the Fed funds rate by 100 basis points.
So, Ed, we did get that a little bit hotter than expected CPI inflation data a couple of days ago. Did that alter your view of maybe how this Fed should proceed?
Yeah, well, the way I look at these numbers is when they support my story, they're good. When they don't support my story, they're bad, or they're going to be revised. And I don't know that the CPI is going to be revised, but I think there are some funky things that happen at the beginning of the year. A lot of companies raise their prices. I know the data is seasonally adjusted, but I'm not troubled by the inflation outlook. I think the important issue is productivity and unit labor costs as a result of that. And the productivity outlook has been strong. And I think it's going to get stronger, and that's going to keep a lid on inflation.
So what's your view, just in terms of taking risk here, Ed? We think about stocks, bonds, alternatives. Where do you see opportunities here, given that economic backdrop, given that Fed backdrop? Mm-hmm.
Well, we've been bullish on the stock market since October of 2022, and there were a lot of opportunities back then. And now things are obviously much more expensive. I think from here on, I think, maybe it's more like I hope, that the rally in stocks continues based on earnings rather than valuation. If it keeps going up on valuation, we're faced with sort of like a 1990s model of the stock market melting up and then melting down. But that could just be a buying opportunity. It doesn't have to be a long-term bear market, and I don't think it would be.
Off the Yardeni, October 22, and good morning to the great technician Ralph Ancampora, who said the same thing. Up 21% annualized since the Yardeni call of October of 2022. We're on YouTube. Subscribe to Bloomberg Podcast, growing each and every day, learning as much as I can about this digital madness. Good morning to all of you outside America on YouTube, just humbled by the international reach. A special good morning today to 92.9 FM. Paul, I got to do this right now. It is the tweet of the day. Fred Lynn, Red Sox, saying that Bregman of the Houston Astros coming to the Red Sox reminds him of Rico Petrocelli.
Oh,
that's almost as important as the next question to Ed Yardeni.
Exactly. So, Ed, we think about this equity market, and I guess that the Fed's going to be more or less on the sidelines, maybe give us one or two cuts. Earnings have to be front and center.
Yes.
What's your view of this earnings power of this market right here?
I think the power is there for the past 3 years, because we didn't think there would be an economy-wide recession. We were among the highest forecasters for earnings. And indeed, for this year, I think we're at the top with $285 a share for the S&P 500, and then next year, $320 a share. And then by 2029, $400 a share. So those kind of numbers at the current valuations can get us to 7,000 this year, 8,000 next year on the S&P 500, and 10,000 by 2029. So it's I think it's going to be earnings driven, and it's going to be technology driven and productivity driven.
And Yardeni, if we get a boom like that, and you're pretty lonely on that, I mean, the character of going out to 2027, 8, and 9 is a lonely stance right now. A lot of people's long term is 1 year. And if we get this, Ed Yardeni, do business practices get sloppy? I had a wonderful talk once with Robert Crandall, the giant of American Airlines. Do people get goofy and misspend CapEx, et cetera, as we go up the Yardeni bull market?
Well, that's the beauty of American capitalism, right? There's a tremendous amount of money available for venture capital, for startups, and it's kind of like throwing spaghetti on the wall. And I think a lot of these venture funds, that's exactly what they do. They invest in a lot of these startups. They provide the capital they need to come up with their innovations, and some succeed, some fail. We always hear about the ones that succeed. We never hear about the ones that fail, but that's the nature of that's the nature of capitalism.
Can tariffs, reciprocal tariffs, Trump economics, can it derail the Yardeni bull market?
Well, a lot of people think so, but I'm very happy that they're using the word reciprocal rather than retaliatory. Retaliatory is what the Smoot-Hawley tariff was in June of 1930. We raised our tariffs without any concerns about the impact in other countries, and other countries retaliated, and we had a world depression. And then to get out of that, the Congress passed the Reciprocal Tariff Act, which basically, the basic theme of that was, please take this power out of our hands. We're too dangerous with tariffs. Let the president do it. Well, the president's doing it again right now. And I think the fact that they're calling it reciprocal, and the president said it yesterday, he said, look, we're just going to be fair, and we're going to match their tariffs. And if they want to talk about it and lower it, we'll do that. So I think this is all going to lead to lower tariffs, not higher tariffs, when all is said and done. And it could be pretty quick. I mean, you see how world leaders are coming to the White House to say, let's talk about these things before you slap them on.
Yeah, let's switch gears a little bit to the fixed income space here. Where do you see opportunities? I mean, a lot of folks can be pretty happy with the 2-year Treasury at 4.3%. Is that kind of where they should be, or should they take some credit risk? How do you think about fixed income?
That's our view, is that the 10-year should be 4.5% plus minus 25 basis points, as you mentioned before. That's normal, and it's normal in the sense it's where bond yields were before the great financial crisis, before the central banks started to manipulate the bond yield and bring it close to zero. I think it's great that the U.S. economy has demonstrated that it can live with these interest rates because they're fair. They're fair to investors who don't want to take a lot of risk and want to have something that's safe, but getting a decent return. So I think the opportunities in the bond market are probably in the corporate area because corporations run their finances better than the U.S. government, as the Doge Committee has demonstrated.
Ed Yardeni, next week, folks, and this is anticipated around Robert Schiffman's schedule, we are going to have Robert Schiffman of Bloomberg Intelligence in for an extended conversation on the lack of debt of the Mag 7. I mean, Ed Yardeni, forget about Modigliani and the rest. The bottom line here is there is ample room to use debt for whatever, CapEx, or to diminish equity. I mean, we can issue a lot of debt out there in this American juggernaut economy, can't we?
Well, the U.S. government certainly has done that, and everybody, including the bond vigilantes, are hoping that the Doge boys are successful.
The Doge boys. I detect a new phrase from Yardeni. Continue, Ed.
Well, it's the shootout in Doge City, right? So I can play with this one for a while, I think where there is a capacity to borrow more, but there's no need to borrow more, is in the household sector and the business sector. It's the government that's on the wrong course, and if the government kind of gets reined in, that crowds out less private sector investments. But look, the Magnificent Seven, they don't have to borrow money. They just generate a tremendous amount of cash flow. Corporate cash flow is at an all-time record high. And companies are cash rich, and they are investing in technology.
Ed, this is a great way to start a Friday here into a weekend of a bull market. Edward Yardeni of Yardeni Research, I can't say enough about it. We protect the copyright of all our guests. Get his wonderful readable research at Yardeni. I can't say enough about the value of that.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Jay Hatfield with us right now with Infrastructure Capital Management. We'll go to Lisa for the retail report and then talk retail sales, the state of the economy with Mr. Hatfield. I got to go, Jay, to what you're looking at now. It's something Paul's alluded to because he keeps watching for West Texas Intermediate with a 69 print. We're not there yet, but nobody's modeling out, not to be dramatic, a collapse in hydrocarbons, but just the bid falls away. When and how does that happen?
Well, I guess one point where we have superior data is that the notion that Trump is going to be able to get the U.S. producer to produce dramatically more is probably incorrect. They continue to be focused on capital return on invested capital. You saw Chevron laying people off.
More than that, huge. Bertha's doing a huge restructure.
Right. So it wasn't really, surprisingly, partly because they're just ineffective managers, Biden wasn't really constraining U.S. production. It was constraining U.S. exports of natural gas, but not oil. And we gather water in the Permian, and our indication is not like they're not going to produce more, they're just going to follow their normal path. So that's not really a good bear case for oil. But what we observe, and I think most people agree, is that this administration has tremendous influence with particularly the Saudis, given that they've sold arms, they used to be supporting the war with the Houthis, and Trump is good at using his influence. So we believe that even if there's very strong Iranian restrictions on production, or even Russian, because they're trying to resolve the war, that if oil prices go to 80, then he would literally call OPEC and say, produce more. And we saw that actually happen during the pandemic. So there's always a range with oil, because we could see 60, we could see 80, but we just made it simple and said 70. We were at 80. So we think it's capped, and all that's important too, because everybody wants to talk about the inflationary impacts of Trump policies, but nobody wants to talk about any of the deflationary effects. Last point is just the dollar is ultra strong. That matters for oil. So it's a very one-sided conversation about inflation, in our opinion.
All right, I want to stay on that topic. You have in your notes here, which is very clear, inflation is always caused by excessive money supply growth, as occurred during the pandemic, and never by tariffs and deportation. Talk to us about that, because I think a lot of the concern about tariffs and about deportations is that they will in fact be inflationary.
Absolutely.
You don't see that in the math?
Well, the first thing that's strange that nobody's really pointed out is it's almost like we had the perfect experiment to prove monetary theory. 75% increase in the money supply, which netted down to 60, 38% nominal GDP, 22% inflation. So it worked perfectly. So the excess monetary growth translated inflation, basically got Biden fired. So thank you, Chair Powell. But that worked perfectly, but nobody seems to care. Like that, Milton Friedman, would be dancing in the streets.
Is Chair Powell going to get Trump fired?
Yeah, quite possibly, yes.
How? What will be that process?
We have ultra tight monetary policy right now. The thing to look at is monetary supply, money supply growth. It's -3, so that implies deflation. In fact, we'll see about retail sales as a lagging indicator, but we think the economy is slowing.
I read Jersey out this morning with a blistering note on tightening off the Fed balance sheet as well.
Right. So the key dynamics, everybody debates, like, was monetary policy tight? When you're shrinking the money supply 3%, that's extremely tight.
Okay, let's do this. Jay Hatfield with us. We're going to come back. He's with infrastructure, capital management. We're going to stagger to a retail sales report on a Friday with Valentine. 114% are work from home today. Futures at -7, Dow futures at -105. The VIX 15.23. Don't really know what to make of it all, other than here we are with yields what they are, and retail sales matters. There's a number of lines of retail sales, and that control group is what I focus on. So let's look at that.
And this is for January, month-over-month retail sales. The survey was for a decrease of 0.2%, came in a decrease of 0.9%. So you see the difference there. When you take autos and gas out of the picture, it goes down to about down 0.5%. And then we want to hit import prices because we've been talking about that so much with tariffs. The expectation was for an increase of 0.4%, increased about 0.3%. Now let's see the reaction on Wall Street. A little bit of a dip. We have NASDAQ futures down 0.1%. 26 points. Dow futures down now 0.2%. S&P futures still down about 0.1%. Moving on to the bond space, we have the 2-year yield at 4.27%. That's off about 3 basis points. A 10-year yield 4.50%, and that's down about 2 basis points. Tom.
Lisa, thanks so much. Yields come in, as Lisa mentioned. And the 10-year real yield, 2.05%, is in a little bit, nowhere near the 199 level. That's really my demarcation, but to 4 digits, 2.0470 on the 10-year real yield. Dollar showing further weakness on DXY, 108, 107, now 106.74. So a sort of quiescent feel there, although the revisions went up, so it's sort of a soup, to say the least. Our economic indicators and all that Lisa Mateo does on economics, it's brought to you by Oppenheimer. Oppenheimer focuses the power of their thinking on you, creating customized plans to help achieve their goals. Put the power of Oppenheimer thinking into your investing, wealth management, capital markets, investment banking. Paul?
So, Jay, looking at the retail sales, again, weaker than expected here. Talk to us about your view of the Fed here. I mean, there's a concern that the Fed is chronically behind the curve because they look at historical data. How big of a problem is that for you?
That's an enormous problem. The Fed, well, they really have 3 problems, but that's the biggest.
Okay.
So as you know, because I was, I believe, leading the charge on this, but
you and Kim Harvey at Duke University.
Okay. So in early 21, because we, of course, do look at oil, that matters, and we look at other indicators of housing costs like housing prices, but now we use just market rents because there's this thing called the internet, and you can see it. Maybe the BLS should start using that. But so the Fed seems to know this, but then they're so slavishly focused on this 2%, like it's some, it came down in a tablet from God. But when we actually publish on our website, which they don't read, that if you adjust that to market, then core PCI is like 2.1 and core CPI is like 1.9. So they should be really concerned about having ultra tight monetary policy and just continuing to cut every meeting. They don't have to do an emergency cut, but they're completely off that page. They've driven the 10-year up 100 basis points and risked a recession in the housing market.
When you were at UCal Davis, did they teach the biblical Fed? Was it about tablets?
They actually did, and I think that's the big advantage because it was 45 short years ago. And monetarism used to be more popular. Now, Keynesianism, it's obviously most universities are liberal, and if you're a Keynesian, it's wonderful because all government spending is great. So I don't even hear any monetarists.
So
really
what is the monetarism is out of vogue? What is the part of monetarism that our listeners and viewers should pay attention to?
Well, I've looked at the monetary base every week since MO. I learned that from you, actually. It's better to call M0 or MO. So it comes out every week, so that's an advantage over M1. And if you just follow that indicator, you'll never miss a big cycle, except things like the pandemic. So in other words, we were on saying, well, the money supply went up 75%. Do we need to be geniuses that we're going to have inflation? Do we really think it's transitory? Or now, or a better example, great financial crisis, we had 0% monetary growth for 4 years before the economy blew up. Now we have 3% negative. So we would have said before, as I guess I did, that, we think retail sales lags, but we could be weak. Well, this is really weak, negative 0.8. And nobody cares about the last GDP print. It was only 2.3.
We're going to get you on before the next Fed meeting to talk about this. It's a thing from a different time and place as well on monetarism. Jay Hatfield is with infrastructure, and we thank him for the InfraCap as well.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Now, let me explain why this is important. Lindsey Piegza was my Economist of the Year last year. There's other people that have got it right. Forget about disinflation. There's going to be a sticky inflation. Alarian out front in this. Jim Bianco was out front in this. But no one wrote week after week after week intelligently about this like Dr. Piegza. She darkens the door of the studio today. She is with Stifel Financial. Lindsey, again, congratulations, because the data that we saw this week clearly alludes to your tone. And I got Richard Clarida in the FT saying disinflation tendency is place. Edward Yardeni in the 7 o'clock hour says the disinflationary tendency is in place. Is the disinflationary tendency in place?
Well, the data doesn't seem to suggest that. The data suggests that we did have strong disinflation, but as of last year, that trend now remains increasingly uncertain, with many of these key metrics moving to the sideways, and more recently, we've seen an acceleration.
Right.
With the PPI, the CPI accelerating for the past 3-4 months, some of these underlying key metrics more than double the Fed's intended target. That doesn't give me or Fed officials much confidence that we're going to reinstate that disinflationary trend.
I saw auto insurance up 11%. You're in the wheelhouse of this in the Midwest. There's a cottage industry, Dallas, Chicago, Cleveland, of taking the 78 things or whatever that make up inflation. I want to pick out this. I want to pick out that. I want to pick out this other thing as well. Paul and my viewers and listeners hate that because they're paying the bills.
Correct.
What are people feeling away from the contrived CPI series?
Well, if we look at this morning's retail sales numbers, we know exactly how consumers are feeling. Even if we parse out some of the weather effects or some of the effects from the fires that we saw in the recent times, what we're seeing is consumers responding to the ongoing burden of elevated prices, and that's forcing somewhat of a pullback in expenditures. Now, again, this isn't an end-all. We have seen consumers spending at a relatively resilient, relatively robust pace, to be honest, for the past several months. But that burden of higher prices is forcing a slowdown in the pace of consumption for consumers, and that's going to be a big challenge for top-line GDP, as we know the consumer is the backbone to the economy.
So if I'm the Federal Reserve, do I stick with you could argue this data suggests that maybe they should in fact be thinking about cutting rates. And maybe that whole discussion of maybe lifting rates, that's completely off the table. How do you think the Fed is going to interpret this retail sales data?
I think the Fed is looking at the data coupled with the hotter than expected reads on CPI and PPI, saying we need to be firmly positioned on the sideline to allow the data to further evolve, give us time to assess the data and assess the impact of the incoming fiscal policies that are coming down the pipeline. So the Fed wants to take its time, be patient, and as Chair Powell has said, they are in no rush to move policy at this point. Remember, they've already made a series of policy mistakes along the way. They were late to the inflation taming party on the front end. They didn't raise rates high enough on the back end. Now what we're stuck with is stubbornly elevated inflation and rising fears of potentially emerging weakness on the consumer side or in the labor market.
I'm going to let you pick 6 months, 12 months, whatever your duration is. Real GDP and nominal GDP. And does that allow central banker to the world, Donald Trump, to get his low-rate regime? I mean, where are you on real and nominal?
No, I think it's going to be very difficult for the administration to see a realized reduction in rates as they would like to see. Now, that's nothing against the current
Wrapped
administration.
around what? Buoyant, solid, real GDP?
I think real GDP is sub 1% for the next 12 to 18 months. I think that's going to be very difficult to get above when we look at these still elevated inflation levels and we see this loss of momentum, a clear loss of momentum in
nominal
consumption.
under, I've never said this, Paul. Nominal under 4%?
Nominal under 4.
Oh, you're killing me.
It's not necessarily a rosy outlook, but I think it's a realistic outlook that we have to contend with.
Can the Red Sox win this year? Can they take the pennant?
I wouldn't be able to speak intelligently about that. But
You are talking sub 4 nominal
I think it's a
and
realistic
sub 1%
risk.
GDP.
Tom, that's why I'm so concerned about stagflation. This Fed is so concerned about avoiding negative growth that they're willing to tolerate above target inflation for a prolonged period of time, eventually choking off the upside potential for the economy.
Extrapolate. I mean, we're just among, nobody's listening today. It's Valentine's Day. You wear Cubs blue. Thank you. Lindsey, if you get that scenario, what does that do to non-farm payrolls or the unemployment rate?
Well, we've already seen non-farm payrolls lose momentum over the past couple of years. We're talking about an average pace of 166 since the start of last year. So if we continue to see this erosion in the upside potential of the economy, I think we get closer to 120, 130 on a monthly basis. That drives the unemployment rate up into that range of full employment, as the Fed has been looking at for quite some time. And that gives them somewhat of a more stable labor market. We're not concerned about overheating, but it does perpetuate.
I don't agree. Vice Chairman Trump, Paul, is going to go mental. That's what's going to happen.
Well, are you concerned about these inflation risks that may or may not come from tariffs and from change in immigration policy? We had a guest on earlier today say that's not the problem. The problem's always just money supply. Don't worry about the tariffs and things like that. Do you worry about the tariffs?
I'm concerned about the already ingrained level of inflation in the economy. That's my primary concern. The implementation or the use of tariffs to negotiate better trade deals, to negotiate cooperation in international conflicts, or to cooperate in terms of more stringent immigration rules, that's where I think the administration is ultimately headed.
Okay.
So I think the most dire scenario of 40, 60% tariffs being implemented, that's really off the table. I think a more realistic scenario is a much more diluted or muted scenario.
So what's
you're
not doing a fixed income ballet, but what's your fixed income regime here? Do you see a 10-year real yield peaking out 2.20, comes down to 199, right now 203. Are you looking for the real yield to just completely break down to like a 170?
Not entirely, because remember, the things that are going to keep the longer end of the curve elevated is this wake-up call that investors have been having.
Deficit,
exactly, about $34 trillion in debt, a deficit pushing up to 7%, double the historic normal. So I do think that investors, they have pushed that to the wayside, and they pushed it to the wayside last year amid the notion of the Fed eventually cutting rates. But if the downside potential for monetary policy is essentially stalled, and we see fiscal policy continue to expand the balance sheet, I think that's going to provide a very solid floor to longer-term rates.
So when we see a retail sales data points like today that are significantly weaker than expected, is that a one-off fires, winter weather, which I hate using the weather, but a lot of people do, including every retail analyst out there. Is that a one-off, or is that something that we should really be concerned about, do you think?
Well, I think we can explain away a lot of the weakness because of the weather, because of the fires. But I think it's also reflective of this underlying pressure, as we talked about, because of this rising and elevated rate environment, cost environment for consumers. I think it's also a reflection of consumers' uncertainty about what is coming down the pipeline. And we saw that reflective in consumer confidence taking a sizable dip at the start of the year. So consumers understand that right now their financial footing is very much a question mark. And that's playing into their near-term decisions of expenditures and their confidence for the longer run.
Forget about the Piegza theater of a sub 1% real GDP. Let's go halfway there. We get to 1.7% real GDP for some quarter that's out there somewhere. When do they cut rates? That's got to be almost not a force majeure, but it's almost right now I would say in the framework of people, it's almost a crisis to get a 1.7 statistic.
But it's important to understand the motivation behind the rate cuts. Because I think at this point, when we look at the Fed's motivation early on, it was to counteract the fear of emerging weakness in the labor market, which failed to materialize, as well as the desire to pass through as much relief as possible before the uncertainty of the new fiscal policy agenda was coming into play. Now the motivation shifts to simply diverting policy from still firm territory back towards neutral as the economy normalizes.
I mean, Paul, what are we going to do with a 1.7% real GDP and the mortgage rate 7%?
Coming down.
Tell me what the housing market does.
Yeah, that's going to be a challenge right there. Lindsey, talk to us about inflation and when do we stop complaining about inflation? When do we say, my price of cornflakes...
When it comes down.
But my price of cornflakes is 20% higher than it was before the pandemic. But it's been there for 3-4 years now. When do I stop complaining about that jump in my price of cornflakes and say, oh, it's only up 2% year over year?
Well, I think we actually did see that over the past couple of years. This expectation of consistent monthly increases of 0.2, 0.3, even 0.4 to your point. But I do think at this turn of the road, consumers have reached a precipice where they're going to be increasingly unable to continue to foot that consistent price increase. And that's where it's starting to weigh now on these shopping decisions, on these consumption decisions, on consumer confidence. Remember, consumers have been increasingly reliant on buy now, pay later options, but that only lasts for so long. With credit card balances at 1.2 trillion, delinquencies are starting to tick higher. Now, not meaningfully so. I think when we look at the vulnerabilities of the household balance sheet, they're still relatively moderate, but we're starting to see indications of, again, that emerging profound weakness.
This is really profound. I mean, this is really, really a good conversation, folks. To summarize, Lindsey Piegza is looking for real GDP really to come in, inflation to be a little slower, stagflation in order. Good morning, Professor Summers. If we start with any central bank as ex post, and you've nailed this, how ex post is Jerome Powell, particularly given White House pressures?
Well, remember,
I'm looking for a rate cut call. Can I get one? It's Valentine's Day. Give me a gift.
I think right now the Fed still is desperately trying to provide additional relief. But they're only going to be able to do that if they see inflation arrest this upward trend. They don't even need to see inflation resume the disinflationary trend. They just need to be convinced that we're going to continue to move sideways with no further upward pressure, and or we see sizable indications of emerging weakness in the labor market. But we need one or both of those scenarios in order to justify an additional rate cut. Now, will we see significant rate reductions under that scenario? Likely no. One, at most two. But again, that is further justified as policy remains in firm territory, and we want to get back towards neutral.
All right, Lindsey, it's pitchers and catchers. Baseball season's back. Can I ask you a Chicago question? You're a Chicago native.
Absolutely.
Cubs, White Sox. What determines whether you're a Cubs fan or a White Sox fan? Is it simply geography?
It is geography. It's proximity. Yes, it's where you live if you're on the north side versus the south side.
And so how does that work out for us? You're north side, you're a what fan?
If you're on the north side, you're typically a Cubs fan. On the south side, you typically root for the White Sox.
Really?
Yes.
It's not like handed down. Like here,
No.
Mets, Yankees, I think it's kind of who your parents are. and how they
There
raise
may
it?
be some of that over the generations,
more
but the hard
geography
line
there.
is typically designated towards
See,
the geographical.
I don't have a great feel for Chicago. I love Chicago. But I don't have a good feel for what drives kind of those things. So I'm glad you cleared that up for us. See, Tom? That's
Lindsey
how it
Piegza, thank you so much. Really thought-provoking. We can't
you for
say
having
enough
me.
from
Economics and
Stifel
baseball.
is well.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
A daily look at the front pages. We're going to do that right now. We're going to do that with Lisa Mateo. It's a special edition of our front pages report. I'm so far behind, I'm like trying to get a FedEx on the Rock Valentine's Day card for Lisa.
Oh, okay.
It's
There's a
there
thing
he
there.
is.
I
I hope he
appreciate
gets a royalty on that. Lisa, what do you got?
Thank you. Well, it's been cold here, right? Rain, snow, it's been kind of miserable, but we are getting closer to outdoor dining season. April 1st is the day when you start to see everything come out. The problem is that there's a backlog of applications. So the Department of Transportation, they're the ones that approve the licenses for them to build the sheds and do all that outside.
This is the sheds on the
Yes.
street.
So
The
we still do
sheds.
that?
We're still doing it because remember
Okay.
they took them down
Right.
last year because some of them were an eyesore and
All-
that kind
most
of thing.
of them, yeah.
A lot of them. So the Department of Transportation has to approve the licenses. So about 4,000 applications have been submitted.
Really?
39 have been approved
Wow.
out of 4,000. So
I didn't
there's
know
a backlog.
I didn't know we were still doing that.
We're
Yeah,
still
okay,
doing it. So
okay,
now
all
they're
right.
kind of giving the restaurants the green light. If they put in the application, they can build the shed on
Okay.
April 1st if they apply by the certain rules. But it's just
Okay.
it's a pretty
All right, well, it's good for them.
it's
I
a little
don't
bit
know.
of a mess.
Just being in Paris, I wish we had the sidewalks of Paris
Yes.
so the cafes were
Cafe thing,
comfortable
right.
outside.
Right.
But our sidewalks are just too narrow.
Yeah, I
They're
mean,
just-
the outdoor dining was great during the pandemic.
Yes.
Thank goodness it saved, I think, a lot of restaurants.
Oh,
It was
yeah.
great
Sure.
for consumers.
It's their lifeline.
But I don't know how much it, I don't know. We'll have to see
Well,
how the city goes.
Dan Doctoroff, full disclosure,
Yep.
folks, used to work here, huge support of mine. Thank you, Dan. Dan Doctoroff provided leadership here
yep.
on the safety issue of them. And what, Lisa, you're talking about is the now what?
Yeah.
Right,
Okay.
right.
Interesting.
And
What do you
that's
got
why-
next?
So we'll see what happens. Okay, more adults are actually eating off of the kids menu. So there was
can
a
do
study
that.
that came out. A number of kids' meals placed by adults rose 28% last year compared with 2019. The reason why, the smaller portions, right? Lower calories because a lot more people on the weight loss drugs. So now they need the smaller
huge
portions.
issue. Huge
so they
issue.
go to the kids menu. Cheaper prices too, and hey, you get a toy, to go with it, or a prize to go along
I
with it.
literally go, Paul, to a certain restaurant, pretty fancy, on the Upper East Side, because their portions are smaller.
Yeah.
It's not. What was the one? One of the big chains.
Mm-hmm.
Like their gimmick was you would go home with both hands full with stuff.
Yeah, or
Yeah.
even you go to a diner and your plate for
Yes.
like breakfast is ginormous.
We split it.
But
We'll split
do
our,
split.
our dinner entrees a
Yeah.
lot.
Ah,
A lot.
okay.
Do they let
Or
you
all
do
the-
that, or do you have
Yeah,
to charge?
no, they do. And sometimes you get a charge. And sometimes I just order the appetizer thing. But the exception is Cracker Barrel. You go in there full bore. Country boy breakfast. Bring it on. But you're right. All right.
But and the thing is there's an age limit, right? It's like 12 and under or something. A lot of restaurants, but the
You know, I
restaurants
just
are
had
just
an
letting them
image,
go by.
Lisa. Paul Sweeney at 2 a.m.
Yep.
in Shawaf between UNC
Durham,
and
North Carolina.
Duke.
Exactly.
I got an exam in statistics. Please help me. Next.
Okay, last one. The rise of the three-pointer. Okay, they're saying it's kind of changing basketball. They don't know if it's for the good or for the worse. Steph Curry, of course, a big thanks to this because he established himself the best long-range shooter. So now these generations of basketball players who watched him and look up to him growing up are now in the NBA.
Yeah.
So now you have more of these guys shooting from the outside. Even the taller guys, the over 7-footers,
Yep.
are shooting behind the three-point lane.
Wembanaya, or whatever that guy's name is.
Yeah, I know.
What do you
Thank
think,
'cause I
Paul?
couldn't
Should they
pronounce
pull it back?
No, it's just the evolution of the game. I mean, and all the if you can't shoot the three, I don't know how you get to a good college.
Oh, come on. They shouldn't knock the thing back 3 feet or 4 feet to
They
make
could,
it harder.
yeah, they could.
Challenge
And then
them.
the players will adjust. I think,
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg terminal.